longer. I like that. It's good. I got into it. It's sort of groovy.
Hey.
Welcome back, everybody. Really appreciate you coming to join and learn with us again today. As usual, Sandy McKay is here with me.
Hey, yeah, Rob, super excited to be here, and we got some great guests lined up, so we're gonna have a phenomenal show ahead. I'm excited to talk about this topic in particular because it's a good hot one for a lot of people buying, and especially in the bigger markets. We're gonna talk a little about multifamily today, so looking forward to that.
Awesome. Yes, me too. And before we get into that, though, everybody should go over to our website, breakthroughreipodcast.ca, download our free gift, and just like get in touch with all of our past guests. Excuse me. I'm just getting over like a little bit of a cough. I wasn't really sick. I didn't feel bad. It's just like all right in my throat. It's kind of annoying. But
working too hard. Working on the pool too hard.
What's that?
Working on your pool too hard.
Yeah, something like that. Yeah. Anyway, yeah, and the free gift, right? Sorry, I got lost there for a second. So we got that free gift. What are people going to get when they sign up for that free gift, Sandy?
Well, they get the ultimate strategy for building wealth through real estate. Of course, they'll find that in their inbox when they go do that. But beyond that, and more importantly, is they get connected with us on a deeper level, and they get to hear about all the tours, seminars, whatever the heck we're doing, new episodes, trips that seem to happen now almost yearly. Am I right, Rob? Down to Costa Rica and other various places that we're running things like that. So yeah, definitely they want to go subscribe and not miss out on everything we got going on.
Absolutely. Yeah. And speaking of the investor, well, like you said, right, they're going to be able to learn about any tours that we have. I don't know if you're running tours. If you're not, you should. But we're running them in Peterborough still. So contact me about those, and you can learn about, converting single-family homes into duplexes legally, converting single-family homes into legal student rentals in Peterborough. So we're doing those once a month, and also we do have that Costa Rica 2023 investor event coming up November 24th, 25th, 26th this year. It's flying up fast. We still have a few spots. I do have some people signed up, and we've got some of not the properties obviously lined up yet, but some of the activities. So the hotel rooms are all booked. So, it's going down again this year. So if you're interested, come down. We go see properties. We network. We talk to specialists in the industry down here, and we go out and have a lot of fun. We do case studies of all the properties that we run through too. So it's going to be good. It's going to be good again this year. So get in touch with me. I don't know, Rob at mrbreakthrough.ca. Sandy, do you have something coming up?
Well, what are we working on? We're definitely doing our Vaughan Investors Club, which people should come check out. I know Mark and I were hanging out there a couple weeks back. Mark, okay. I haven't even introduced our guests yet, but yeah, Mark Baltazar coming up soon, and Mike Rockall coming up soon. Hang tight, guys. But we were hanging out there a couple weeks ago. We did a great event, and this seems to be growing and getting a lot of great connections built there. So if you're someone who's in and around the Greater Toronto area, that's an easily accessible club to come hang out with month to month. So our next event would be just after this episode's launching. So I think we'll be on September 20th, Wednesday evening, and they can go to vaughninvestorsclub.com and pick up all the information around the club and what to expect and all the dates for the events upcoming.
The calendar's on there?
Yeah.
Okay, cool. Yeah, go over there and get that. Is it like the third? Is it like the third?
Usually the third Wednesday of every month.
And
there's a small fee. You can join as a member and get access to everything. And we'll do some tours and stuff in the near future. But the best part is just seeing people connect and build their power team in this great field of real estate, because that's where Rob and I met. That's where you and I first got connected. And so it's you never know what connection can turn into a 10-year relationship and podcast, or who the heck knows what it flourishes into.
Yeah, for us is what you were alluding to, though. It got us talking to, I don't know, countless I don't even know what episode we're on though, but countless people here like helping us learn. And we just decided to share that with everybody. So it's been fantastic. And today is no different.
Definitely. Let's bring in the guests. We
Absolutely.
got Mike Rockall, Mark Baltazar here from Peak Multifamily, I should say. And they are second-time guests, actually. I don't have the episode number from before, but you can go back and check out their episode. I think it's a couple years back now. And of course, they run Peak Multifamily Investments, which is a real estate investment management firm specializing in building generational wealth through apartment buildings. And they, of course, acquire performing apartment buildings and systematically redevelop them into strong returns for, of course, themselves, but mainly their partners. And so they've been doing that since, in some way, shape, or form, since 2012, and manage an awesome portfolio across Southern Ontario. I think just Southern Ontario for now, right, guys?
Yeah.
Well, why don't you share with us a little bit about the backstory on what you guys have been doing in that space and how it's evolved to where it is today? I think you're at over 40 plus million in holdings there.
Yeah. Maybe Mike, you want to start, because you bought buildings first, and then we collaborated, and then kind of we're here where we are today.
Yeah. So my background actually goes back to 2010 when I purchased my first triplex. Kind of got addicted, so kept on that path. Was working as a full-time plumber. Built a portfolio up of about 42 units in that kind of size range: duplexes, triplexes, fourplexes. And then in 2014, I started to struggle a little bit with mortgages and whatnot, so decided to level up into apartment buildings. So purchased my first 12-unit apartment building in 2014. Was still working full-time at that point. A couple of years later, decided to get my realtor license, left the plumbing career, and then kind of joined up with Mark. I believe it was on a flip, a house that we tried to flip that turned into a build. Wasn't my expertise, but I knew Mark was flipping homes with a mutual friend at the time. And then in 2018, we decided to partner up on buying an apartment building. And then, from 2018, now the last 5 years, that's where we've been full-fledged in buying apartment buildings. And then from the agent side as well, that's where, 95+% of my businesses come from, the multifamily sector, and helping, other guys buy apartment buildings.
Very good. Appreciate you sharing that. And I just want to say I didn't say welcome to the show yet. So thanks a lot for being here, guys. And Mark, what about you? What was give us a little bit of up to speed and right up to where Mike ended, and then we'll dive into what you guys have been doing together.
Yeah, I think so. Just by way of background, I mean, I came from the world of management consulting, and cool business. I was a partner in a firm, and then there was a lot of travel, a lot of time away from family and such, and real estate kind of seemed to be the path I was going to go down eventually. And then Mike and I collaborated. So, as we started to build the multifamily portfolio, we started with, acquiring ourselves, essentially a mutual friend as a partner. During my flipping, I guess, phase, I started off with a partner that would, an active partner. And so we would fund our deals ourselves. And then we started attracting, passive investors who kind of, family and friends. Hey guys, you guys are doing stuff like that. If I have money, need to put to work. And so that was kind of the first time that I had realized that, okay, you can use other people's money, in real estate. Fast forward to multifamily, while Mike and I do have buildings on our own, the majority of the portfolio is with passive investors. So people that are looking to, get exposure to multifamily, the asset class, all the dynamics that come with it. Most of them are professionals. They have their own careers. They have other stuff that are going on and can't really be bothered to manage the day-to-day operations of, an asset class like multifamily. Because, obviously, as you guys know, full-time, it's a full-time business. And so I guess up until 2022, and still to today, but mainly up until 2022, we worked with, accredited investors, would partner on our buildings. We'd kind of buy a building, raise money, buy a building, raise money. And it worked for a bunch of years. And I think, our aspirations started to grow a little bit in terms of scale. I wanted to scale a portfolio, wanted to kind of streamline capital raising, wanted to access, a larger pool of investors, not just accredited investors. And so it led us down a path to start kind of figuring out or discussing and weighing, I guess, the pros and cons of starting a mutual fund trust and a fund. And so that's where we are today. So we've launched a fund, and we're continuing. We're buying the same type of real estate. The model's the same, value add, buying underperforming assets, repositioning them, growing the value so that, our investors benefit. So the model's the same. Our capital raising efforts have changed a little bit.
So what do you think is the biggest difference and the biggest benefit of the way you were doing it and the new fund?
I think so. The big reason was scale, right? A big part of it is scaling. Going beyond where we were, and we felt that capital is a big part of scaling. I think Mike can speak to this in terms of deal flow. That wasn't an issue for us because Mike has good connections in the industry. Capital, we started to want to go beyond accredited investors and started to tap into registered funds, TFSAs, RSPs, because there's a big chunk of money, that people have that, aren't performing. So we figured that we could, need to access that somehow. And so the ability to access capital, I think, is really the big benefit. On the other side, there's more compliance stuff you got to deal with, right? So there's more administrative work. There's more, back office stuff you have to deal with, right? Reporting, right? So, while yes, it opens up the gates for more capital, with that, because, we're dealing with the securities commissions and exempt market dealers and, reporting, there's also more work on the administrative side to kind of make that happen as well.
And would you say it's a completely different partner who comes in on this kind of investment as opposed to before, where maybe they were a little bit more involved? I'm not sure, but maybe a little bit more involved with the building itself. And now it's more, just based on a return, really, is it not?
I would say that, so the persona of the investor is slightly different. Not on the kind of passificity scale. Like they're still just as passive, fund, not fund. I think, accredited investors, they are a little more sophisticated, kind of by definition, and they are, right? So they're more sophisticated. They have higher levels of income. They tend to spread out their capital into different areas. They have, I'd say, more knowledge of investing and kind of what it means. Risk tolerance is slightly different. Whereas, let's call it this new market of investors, we call it the retail market of investors. They're coming in with a little bit less. Our minimums are lower. And so they're not used to investments like this. So there's a little bit of education kind of required. And so, a lot of our marketing is about education and what it means to invest in real estate. So it's a different profile in terms of the level of, passiveness. It's probably the same in terms of, wanting to be involved in real estate. They don't really want to be involved in the day-to-day tenant management, all that kind of stuff.
And I just wanted to add something to that. It's a little bit of a different product, right? People who have money in their RRSPs, maybe in a mutual fund that their bank has suggested, they don't know where their capital is really being invested. And that's kind of who we're competing with. It's like you can take your money out of a mutual fund you have with TD or CIBC and now self-direct it into our fund and kind of understand that, hey, it's in multifamily. It's still my RRSPs or my TFSAs or whatnot. So it's different in that aspect where we're more competing, I would say, with people who have money in mutual funds.
Yeah.
What does it end up in? What is the actual product there? The style of investing that you guys are using those funds to invest into? Is it one building? Is it 10 buildings? Is it any variation of that?
Yeah. So it's a great question. So I mean, it's a portfolio. So it's a portfolio building. So I think kind of comparing and contrasting what we did before versus what we're doing now. If an investor invested with us before, it'd be one building, right? Which just has again its pros and cons as well. Now, so we can argue that it's a little more mitigates the risk a little bit more. Your money is not in one location; it's spread across a portfolio of buildings. So there's risk mitigation there. There's diversification of portfolio. So that's exactly it. So the purpose of the fund really is so that you're getting exposed to multiple assets, multiple markets, and because of that diversification, you're essentially mitigating a little bit of that risk.
Okay.
Makes sense.
Yeah,
And
and
then
just to add to that, like our fund is a $50 million raise, so we plan on raising 50 million and then going off and acquiring assets with that. Not keeping in mind that as buildings come up for refi or whatnot, that additional equity would then go out to acquire even more. So in terms of one building or multiple buildings, as we raise capital, we're going to just keep going out and acquiring till we hit that $50 million mark.
Does that mean 50 million deployed or 50 million in asset value? So like
50 million deployed, like $50 million raised.
So there could be 150,
million.
200 million in that range. Yeah.
Yeah.
Okay.
Yeah.
Cool.
Yeah. Yeah.
How do you, there's so many questions to ask on this stuff, guys.
Yeah.
Maybe we should go back to a little bit foundational before we keep going in on these, but like, I want to understand what you've kind of alluded to it, but what is, like, there's different types of funds that people can start, right? So this is not just the exact same as a more traditional. We've had folks on here talk about a GPLP structure would be the language I think we've used, and other forms of like syndicates. What makes this one unique or different compared to the other variations out there?
I think the big differentiator is the ability of investors to invest registered funds, right? That's a big part of kind of why we did it. Listen, my personal mutual funds in RRSPs that I kind of put with an advisor, a few years ago, got cut in half last year, right? Real estate, yeah, sure, real estate stabilized, but didn't get cut in half, right? So, and I think Mike alluded it too, and we're learning more about this as we go along. A lot of times people put money in RSPs and they just kind of forget about it, have no idea, which is surprising, have no idea how it's performing. So the big difference is that we can access registered funds, TFSAs, RRSPs, RESPs, and just gives people another option. And the interesting thing, as we've embarked kind of in this new space, is that there is little knowledge about the fact that you can put registered funds into real estate, right? There's kind of this kind of mystique around it, right? I think the four of us have been in the industry for long enough that it's kind of common knowledge, right? But for most people, it's a new thing, right? It's a new thing to do that. So that's I'd say probably one of the biggest differences. Mike, anything else there's other differences, but that's probably the biggest one.
Compared to like an LPGP, I know you asked the question, but in terms of like other funds as well. I mean, I'll get into both actually. Like from a fund standpoint, depending on what fund or whatnot, some of them are really big. People don't like it because they don't know where their money. They know what's going into multifamily. We're more of a value. Well, we just started this year, so we're more of like a value-add boutique fund. So if people want to touch, feel, and see assets, we do offer that. We can schedule something where they can walk through, kind of see what we're doing, have conversations. They can pick up the phone and talk to us direct. So from a standpoint of dealing with other REITs, that's where our value prop comes in. I think from the LPGP side, in most cases, just the low entry to barrier. I don't think people in LPGPs are taking in $10,000, right? And they're having to stick to accredited investors. So for example, what happens to that executive that's been making $175,000 a year who now doesn't have access to an LPGP? They're just not accredited, right? They legally can't take their capital. They're having to come kind of through the fund side of things, the mutual fund trust, to now be able and be that eligible investor, right? Because that's in reality of it, and we have these conversations all the time. It's kind of almost, I don't want to say sickening, but you need to be accredited to have access to these very stabilized assets that do well year over year, right? If you're not making a certain amount, you just can't go off and invest, right? So having, an actual fund allows, the average everyday person to go in, go through suitability, see if it's right for them, and, have a regulated investment that's been, performing year over year, essentially.
And so maybe we should distinguish this for our listeners too. If, to be an accredited so you don't need to be accredited to invest in this, correct?
You do not, no.
And so a lot of funds you do, and accredited being, there's a few ways to be accredited, right? You either have to have a certain amount of net worth outside of your personal residence, which I believe is it $1 million or is it more than that?
I think net worth is 5 million,
5
liquid assets, like liquid cash of at least $1 million, income 2 years of 200,000 or more, or family income of 300,000 or more.
Right. So if you don't qualify for any of those points, this is a great option, even to our listeners that are out there that have a bunch of registered funds, which I know there's probably plenty of those. They can access a fund like this, be invested in cool projects that you guys are doing, and not necessarily have to go through waiting 10, 20 years before they're accredited or whatnot to invest in things like this. And be passive and potentially learn even on the way, being the fact that you're a little more boutique. I imagine there's, like you said, a little bit of opportunities here and there to go check out the site, or
absolutely.
I imagine there's some good learning opportunities there for some people.
Sorry, guys, I thought I hit mute. I apologize. I hit the button. It didn't work. I had a question for you. What are your expectations for this $50 million? You must have some kind of a roadmap of what it's going to look like as far as an investment, or as far as investments go, at least some kind of idea of what that's going to look like when fully invested.
You want to take this, Mark?
Yeah, I was going to say, it'll get us, and I think Sandy alluded to it a little bit as well, 130 million in assets or so, 130, 140 million. I mean, depending on what's going on in the market at the time. And so that's the other thing, kind of going back to, our objective is scale, to operate a portfolio, the efficiencies really start to kind of bear fruit and really start to, make a lot of sense kind of as you get closer to the $100 million mark. From an operation standpoint and such. And so the 50 million should get us to kind of past that and kind of into the 130 million in terms of assets.
Okay. And that's going to be all in Southern Ontario.
I mean, at this point, right. So so the fund can invest in other markets in Canada. We have, we're here right now. So in Southern Ontario right now, that's kind of where that's where our buildings are. It's where our systems are. It's where our team is. We've looked at other markets. From an ROI standpoint, the Ontario market is super strong. And I think we're both bullish on the Ontario market, given what's happening just economically. So supply and demand. You don't see the supply and demand discrepancies here in Ontario that you do in other BC is probably another similar one, but look at Alberta and Eastern provinces, good markets, but you just don't have the demand and low supply dynamics that you have here. And with immigration and everything else that happens, and just investment from the Fed and provincial governments, like I think we're kind of at, as one lender kind of told us, you guys are at center ice where all the activity's happening. And that's important, especially when, the economy fluctuates, right? Whether it's in a recession as we are now, we're about to go into, I think we're pretty confident that kind of where we're headed, or when it's boom time, good, strong markets like Ontario perform well, and especially in multifamily. So, I mean, we are studying other markets outside of Ontario, but the core will still be in Ontario.
I was reading some stuff last couple of weeks around this topic because I feel like a lot of people are anti-Canada in some ways for a lot of people, and anti-Ontario. I mean, from investing standpoint, right? There's a lot of people going to the buzzworthy places.
Yeah.
I don't know if Costa Rica is necessarily that raw, but that definitely was on the list for a bit.
I was going to say Ontario is kind of a buzzworthy investment hub.
It has been, but it's got the LTB, right? So there's always that's always the thing hanging over the investing in Ontario is how the hell do we get rid of tenants when we want them out, and can be a pain point.
Yeah, we got to put our heads together, but I think ultimately, there are ways to get things like that done. You guys would know more about that, but
there's definitely
there's definitely ways to get things done.
It's very pro tenant.
Yeah.
But there's also when you go to these other places, like I think of Calgary right now being quite a buzzworthy sort of place that a lot of people are putting their dollars into in Canada. But you go to Florida, Tennessee, Texas, wherever else in the U.S. that you hear about being Florida for sure being a very hot spot.
Yeah,
I think I think you kind of allude to that, but I see it this way too. And we had Andrew Brennan on not too long ago, Rob. We were talking about the actual opportunities in Ontario and how the fact that it's got the LTV, it actually, it creates opportunity to raise rents quite a bit if you're able to work a deal to replace the tenants. And so those opportunities don't necessarily exist in the same way in other provinces because they don't have that same challenge or opportunity. But it's also, these major markets, like I never hear people talking about in the US, let's say like a Chicago or a San Francisco. San Francisco is getting crushed. I mean, these are major markets for decades and decades.
Yeah,
I'd be really, really shocked if that market's not coming back soon. And Toronto and surrounding is not necessarily at San Fran levels, but it's gotten hit a little bit. It's a little bit, I would say, slightly under the radar for the moment, while other people are scattered doing other things. But it's the New York of Canada, right? I mean, it's where the hub of everything is, and surrounding it. I can't ever foresee it not being a great place to be invested in.
I don't claim to be a genius, obviously, when it comes to do with any of this immigration stuff. But I mean, if you look at the housing crisis that we're in, I mean, it's a pretty predictable predicament that we've found ourselves in, I think, as far as the housing crisis goes. And I just wanted to get your thoughts on like the market now because of that, and maybe the unlocking of some greenbelt land and that kind of stuff for development.
Mark, you want to go first, or you want me to take this?
No, go ahead.
So, I think right now with the housing crisis, I think it's not going to get much better unless the government comes up with a bunch of incentives for developers. So I've spoken to a bunch of developers, and projects are put on hold. Just the cost to build things, the red tape around it, and then the values right now with interest rates where they're at, it just doesn't really make sense, right? I've spoken to investors on the other side of things who used to invest a lot of capital and smaller family offices capital into these development projects with some of the larger developers and Tridel and whatnot. But even the length of these projects, like to actually purchase something, get it to the breaking ground, like your 10-year plus projects and timelines in a lot of these projects, right? So investor capital now, at least from conversations we've been having, wants the option for some shorter term. Like it could be 10 years, they could pull out. So with the amount of immigration happening and the pressure for developers to build with no profit, like if they don't open these green belt areas, like I don't know what's going to happen, right? And a lot of these developers, in most cases, they have capital. They can sit, they can wait. They're wealthier individuals. They're not going to build something for no profit. I do think
and
right
I'm
now
sure
too,
the incentives are coming. I mean, government loves to. Well, that would be one thing that's actually good as a stimulus, but the government does love to spend up that money. So
I'm sure they're coming. This has been an issue from as far as I can remember, and goes way back.
Mm-hmm.
Is it going to solve the issue? I mean, even with the new bill that passed and garden suites and all this stuff, I'm sure it alleviates some pressure, just not enough. And I don't know how well endowed you guys are with the residential side as well. But a lot of conversations I've been having with agents in the office is that they're looking at homeowners who are saying, hey, we need to sell. We have some mortgage renewals coming up. We're paying in the mid 2% range. We can't afford to pay 6.5%. So they're selling, looking to potentially go off and rent with a big chunk of money. So from the multifamily side, what I see is I see way more demand on the rental, causing rental rates to increase. I see high interest rates, but when those interest rates start to decline, and with this high rental rate, I think there's going to be a significant jump in value, right? Because now the cash flow you're going to get, like we're looking at things now paying, even from CMHC perspective, high fours, and things aren't making sense. Even for a stabilized product, you're buying it at a 4% cap rate, 4 and a bit, and you're paying 4 and a bit interest rate. It doesn't really make sense, right? But as these rental rates start to trend up, which we've already seen over the last 6 months or so, but I think that's going to increase, and the rates start to trend down, I think that's where you're going to start to see like a big gap in values increasing and cap rates start to compress again. The question is timing of it, right? That's been a question. Like a lot of people and investors, larger investors, billions of dollars of assets under management. What I've been hearing anyways in the conversations I've been having is a lot of the guys predicted rates to go up this high. They didn't predict them to stay this high for this long, right? A lot of people thought a cut was coming, the end of this year. Now you're looking, Q1, Q2 potentially. And maybe even if they misread it by 50 basis points, you can be midway into 2024 with rates still relatively high in the mid, at least from a CMHC perspective, still in the mid 4% range.
Yeah. Yeah, I
So
remember
it's going to get tricky.
Well, when they started to go up, I had a lot of my mortgages on variable rate mortgages, right? And then I started to see them going up. So I was like, at a certain point, I was thinking, okay, it's time to lock in. And like that was probably almost 2 years ago now.
Yeah.
And at the time, just feeling sick, just feeling sick to lock in at those rates. But then I did like for the majority of them, I did like a 3-year because that was the minimum, thinking, okay, in 3 years, this is going to look great, right? Everything's going to be stable again. It'll be back down. Now, I'm not too sure. It's only like a year away, and it's probably still going to be higher than it was when we locked in. But I don't know. We will see. I'm hoping that this is sort of the beginning of a little bit stabler market.
Yeah.
Yeah, I've been hearing conversations about just normalizing inflation closer to 3%. Right, because right now they're talking about 2. Everyone's saying we're never going to get back to 2. Why not start looking at 2.8, 2.9 as a norm going forward?
Well, why not just have a range? A range that we need to stay between.
It's a little bit arbitrary.
That range, and that's it.
Right?
Yeah,
it's a little arbitrary. Like to stay on 2. Like maybe there's other stuff I don't know, but I mean, 3 is not a.
So some economists will argue that we're probably there at 2. Like depends on how you measure it, right? Like if you take out housing costs and the effect of interest rates, which was perpetuated by the Bank of Canada in the first place, we're kind of at 2, right? So if you back out, mortgages and housing and such, we're pretty much there. Now, with job growth starting to slow and GDP slowing, I think all the indicators are finally moving in the direction that the Bank of Canada wants. We'll see if it stays, right? That's the thing. I mean, there's another announcement in October, right? I believe. So who knows? Yeah. I mean, as long as those indicators continue moving in the direction that they are now, which is down, and unemployment up, right? Like unemployment, I think is starting to inch up. Job growth is slowing. So I don't know. We'll see.
And that's the thing I worry about with them holding is people jump back in and say, hey, it's only 6 months. Then they're going to cut, I have a little bit of reserves. Let's go out and start spending them now. Yeah. Let's buy this. And you see it in the housing market. And it's like, let's take this trip. Let's buy this. And then what's going to happen is inflation might creep up again. Yeah. If it creeps again, then what happens, right? They're going to increase again.
Question. Because Sandy and I
What's
get
that?
that all the time. It's like,
Yeah.
should I buy now or should I wait to see what happens? And that doesn't matter when they ask it. It's always, they always come to us and say, should I invest now or should I wait to see what happens? I'm like, how long are you going to wait? What exactly are you trying to see though?
Yeah.
So there's always that. But I think, everyone has their level of comfort. I still think that there's deals to be found out there now, even with the climate as it is.
Yeah.
So as long as people are careful, I think that there's always good opportunities out there for people.
Here's the thing too, right? Like I got asked this question. We do some coaching, right? Helping people kind of get into their first building and underwrite and stuff like that, right? So one of the questions I think I got last week was, is this a good time to invest, right? I mean, you guys get it too, I'm sure. And even I think, Rob, you started off by saying that one of your clients said, okay, I think I'm ready now because they've held, right? I think the beauty about buying right now is that there's more certainty as to where the interest rate is going to be than there was 12 months ago. We're buying in a high environment. Is it going to get higher? Maybe it'll go another quarter point, half point the most, if even that, which I think will crush the economy. But the point is that there's less uncertainty as to where the rates will be in 12 to 24 months. If anything, it'll get better. Whereas, a while back, we still didn't know. But I think, if all the economists and even the Bank of Canada, I think, are now saying that, we're gonna hold, let's wait and see, let's see things out. There's less, I think, uncertainty risk in terms of buying. As long as you do your math right and you bake in the high rate right now, maybe it's for another year and a half or two, and you have to lock something in for a 2 or 3 year term. There's way more certainty now than there ever was, at least in the last 18 months.
That's a good point. If you're buying something today and it's a multifamily property, and the odds are your tenants might, if there's tenants there, they're probably paying under market, or they're paying under market for today, most likely. I mean, that's almost always the case. And the opportunity in that I see, because I just look at in our one of our properties, we were looking at the stats around a 1-bedroom. This is in Hamilton today versus, because we had a tenant leaving. The 1-bedroom average in the area that we were looking at in that neighborhood was 1,700. It was 1,300, 1,350, 1,300, 1,350 in that range just over a year ago. So we're like 20+% increase in that neighborhood in 1-bedrooms. And that's, for a lot of investors, that hasn't been realized yet because they haven't been able to get the turnover, right? But as soon as you get that turnover, that makes up for quite a big chunk of that interest rate increase pretty quickly, especially with multiple units, right? So I think that's something that people will start to realize potentially. That's an opportunity there for a lot of these buildings if we can acquire them at a reasonable rate now and know that in the coming years you're going to be able to optimize them from an income standpoint at least.
Yeah. But even from like a net worth perspective and actual value, your cap rate will drop because there's more back end value. So when someone's looking at it or an appraiser's looking at it, they're saying, okay, average rents are 1,700. You're only at 13 or 1,350. There's still a little bit of room there across the building, and your cap rate will be lower because someone coming in buying it now isn't buying something fully stabilized, right? You're just, if you plan on keeping this for a long time, I mean, you're really not seeing it. It's just a paper value, right?
Makes sense.
Yeah.
So can I ask you guys, what are some of the dynamics that you would look at to qualify a building into the portfolio?
Yeah, so there's a few things that I look at that I kind of take a personal approach to. So one of the things now, and we've been dealing with clients that are looking to purchase, and they're looking for so first of all, one of the first things I do is I look at my exit, right? So 5 years, if it's a 5-year, a 10-year, 15-year plan, and all the way through, who's going to be buying this building, right? And then the personal approach I take to it, because turnover in Ontario is always a big factor, right? So as Sandy said, a year and a half ago, a year ago, average rents were 1350. Now they're 1,700-ish. Everybody, all the clients that I'm working with now are looking for these depreciated buildings where the rent is $850, $900 average, But that current unit now, this is the thing that people don't factor in. That current unit now, as is maybe renting for $1,350 or $1,400. So if you're deploying the cash for keys strategy and you're offering 10 grand, 15 grand, the tenants are saying, okay, this is going to last me a year or two. And then what? I have no more money. I'm screwed. I'm on a fixed income. A lot of tenants in Hamilton, they're on fixed incomes and they're starting to realize this, right? So what I'm seeing now in my perspective from a sweet spot that I like are average rents around the $1,200, $1,300 mark. And maybe it's for 2 bedrooms, but what I'm seeing is say your after reno rent is $1,700 for ones, $2,000, $2,100 for twos. That as is. So I'm looking at it saying, hey, I can get an $800 lift. I renovate these units, I can get an $800 lift. But that tenant paying $1,300 can go and find an equivalent unit, not renovated, for $1,400 or $1,450. So it's only $250 more. So now for me to offer 20 grand, they're saying, oh, this is 5, 6, 7 years down the road. I don't know where I'm going to be in that time, right? So it's more enticing. The turnover ratio that we look at tends to increase. So when you're looking at a building that has back to $900 average rents and you're looking at turning over the building, are you projecting a 30% turnover ratio in a say a 2-year period, a 40, a 50, a 60? And then if you look at something with a little bit less lift, but go from a 30% to a 50% turnover, where are you actually making more money, right? Turnover is always an issue in Ontario. And the biggest thing that we found works is actually creating a relationship, a personal relationship with the tenants and creating a win-win, right? And when you have these conversations, you start to realize there's a good chunk of tenants who've been looking to move, thinking about moving, right? They just haven't gotten around to do it. Their kids don't want them in the building anymore. It's not safe. Things happen. But as soon as you create that little bit of characteristic that you're trying to do it to like pad your pocket, or you just want to the term renoviction, you want to do that, we find a lot of the tenants get closed off, right? They don't want to move. Even if they want to move, they want to say, screw you, we're never leaving. Right.
And I think the reality is too, right? Like across the board, across, the country, but mainly in, Ontario and BC and such, turnover has slowed. And so, gone are the days where you can, or you should be underwriting 75% unit turns in 12 months, right? Or 18 months, right? Which makes your spreadsheet look really good. Your ROI is through the roof, but in reality, it's very difficult to execute on something like that. So, our underwriting has changed, right, in this market, and like Mike said, right, like the gaps that we're looking for. So I think going back to Rob's question, like what are we buying? Still value add, 60 to 90% lift in rents potential, right? But we're not underwriting with significant unit turns in a very short amount of time. If we get it, cool, bonus. It's like cherry on top, but it's really hard to buy. Well, you can buy with like that, but to execute on that strategy, it's tough. It's really hard to come to fruition. And so
I guess you can always be ambitious with those goals. And if you get to them, then that's great. That's like you said, extra icing on the cake.
Yeah.
I just want to add one thing to that. The reality right now of buying too is it does take a lot more capital to buy. Something you could have bought 12 months ago, 18 months ago, you can get in it for a lot less capital. Your carrying costs, especially if you're buying value add and you're using bridge financing, your carrying costs you're bleeding to death big time, right? So now that the time frame of turning these units over is very important. Because if you're projecting a 12% time frame to turn 50% of the units over, if you don't, what happens? You bleed to death. You just can't afford to do that, right? So it's a lot harder to purchase. You need a lot more capital. But I also think back to your question, the original question of, is now a good time to buy? I think so. I think it's a really good time to buy because, as mentioned, with these rental rates pushing up and and interest rates starting to come down, caps will also start to come down. So you're going to see that big lift in value. It's just, is it coming in 12 months? Is it coming in 24 months, 36 months? And can you afford to purchase it with a lot more money down and carry these things that much longer, right? So if you can't, you can run into some trouble. If you can, I think there's a lot of opportunity.
And I think even just going back to the fundamentals of multifamily and the asset class, it's meant for long term, right? It's less of a speculative investment, at least kind of what we offer our investors. It is long term, right? We put these things in 5-year mortgages. Typically, there's 6 or 7 year kind of projects per building, and so you kind of you flatten out some of that variability. You get a bunch of principal pay down. You have tenants paying, rent over the course of that time, right? We're not trying to time the market, right? Such as other strategies like maybe development or even flips and such stuff like that. It's, you let the real estate market do its thing. And again, rental, we talked about supply and demand, in Ontario for sure. And in most markets across Ontario or across Canada, the supply issue is long from being solved. Like, look, in Ontario, CMHC put out a report, I think it was June 2022, saying that in order to get a demand supply balance where the market is somewhat balanced, by 2030, in Canada, they need to develop 3.5 million households. In Ontario, it's like 1.9 million. We're not even close. I think 6 months after that report, they came out with an update, said, yeah, we're not going to hit that. Right. So, and now with the slowdown in development, we're definitely not going to hit that by 2030. We're way, way off that. So, and again, that supply imbalance, is a driver of rental demand. So kind of back to economics 101, I think we're in a good place. We're providing rental housing, which is what this country needs.
Those are really, really valuable insights. In particular, I was thinking about, running your numbers around the great deal. That's, the rents are so under market. It's such a great opportunity versus they're under market, but they're not 30% of what the market should be. They're 70, 80% or so. And it's because I've had those challenges for sure. And seen that firsthand. So that's a really, really great point for people that are investing in multifamily. What have been if you were to have two, maybe one each or two each, most valuable lessons learned in this multifamily space over the years? What stands out to you guys as the most valuable lessons that you've taken away in 10 plus years of doing this stuff?
Mark, you want to start?
Sure, I'll do one, and you can do one, and we can kind of go back and forth if we need to do more. I think, especially right now, patience, right? This is a game of patience, and more, I think you start to realize that yes, you want to turn, you want to generate, profits quickly, and you want to refinance capital out. Things take longer than you may expect. So having patience. And patience also includes not swaying too far off of, your plan. If your plan was, well thought out in the first place. And I think that's kind of probably an insight for most businesses is that patience matters, right? Kind of being in it for the long game, the long term. That's a big, it's not my first business, but I think in both of the businesses I've been involved in, patience really is an important discipline to have.
I'll talk in regards to the acquisition side because that's mainly where I focus, and a lot of people struggle to find apartment buildings. And I think one of the main things that really worked in my favor is just strong relationship building. And I've been able to do that just through being transparent. Here's where we're at. Here's what I know. Here's who I'm working with. We're X amount of time out from buying. This is what we like. So really narrowing down on what you're looking to do, being transparent with, people in the industry, and just kind of having that genuine kind of approach to say, here's what I want my life to look at, and really build relationships. Because whenever you're in a struggle or you put something out there, say, hey, I'm looking to buy in 6 months or whatnot, I'll always have people call me to say, hey, Mike, where are you at? Just checking in. We have some stuff in the pipeline. And that's allowed us to have a really good flow of deals coming to us, right? It's just really strong relationship building. And because it's such a small space in the multifamily, and I know in residential, you'll have agents and people put like 10 offers out knowing they're going to buy one, try to get the deal. If you do that in multifamily, you'll be blacklisted. Like, relationships are very important. These are, very smart, wealthy individuals. That's why they're owning apartment buildings. So if they get a sour taste in your mouth that you're dicking around, you're probably not going to see too many deals. And a lot of people don't learn that, hey, it's different than the residential side. These aren't just homeowners. These are, reputable people in the business. And, they get burned and blacklisted pretty quickly.
Yeah, those are good ones. Well, when I think about like some of the biggest kind of mistakes I've made over the years, I think a lot of it, the root of it is not having enough patience. I think that's, anything I look back on almost always comes down to that. Yeah.
You might look at the actual technical thing, but if you dial back, maybe it does come down to that a little bit more than you think.
Well, everyone's trying to get rich, even if it's not quick. It's like quick-ish,
Yeah. What's the fast way? And I think it's not to be confused with not being urgent, because urgency matters, right? Mm-hmm. But taking urgent action on a strategy or on kind of what you're kind of going ahead. So urgency matters, of course, but consistency and patience, I think. And again, guilty of not being patient either. But but yeah.
Yeah, oftentimes you line everything up and then it's just okay.
Yeah. It's a kind of, there's the shiny object syndrome, right? Which I think, the four of us probably have because we're entrepreneurs, and that's kind of just, obviously it's worked, for us to some degree, but especially now, I think there's a lot of shiny objects, right? I guess there always is, but there's always shiny objects, and it's kind of just putting the blinders on and moving.
And I think I just want to add something. I think people got caught up in the burring this and getting my money out and burring that. And because I was never a part of that, I don't know. I do not consider that investing, right? That's like a job. Like, that's not a true, like, I'm buying an apartment building. You're working, you're putting some work in, you're taking your equity out. Like, I don't see burring and real estate investing as the same thing, in my personal opinion.
Well, it's like flipping. I always thought I would say the same about flipping, in general, and burring is kind of a hybrid of that flip model with the longer term. Yeah.
It's like our lawyer, so our real estate lawyer. Actually, I've been working with him since 2015 when I did my first, or 14 or 15 when I did my first flip. He didn't even he called it speculation. It's like, oh yeah, you're doing a speculative project, and that's just the language he uses, and he still uses that today, right? Like, Mike, if Elliot gets into it, he called it speculation. I never really thought about it until a few years ago. I was like, yeah, that's kind of what it is, right? You're trying to time it. You're trying to get in and out. Mm-hmm. Yeah. So cool.
Those are good stuff, guys. Lots of value in this conversation, I think, for our listeners. And I love the usually when we talk about these bigger deals, not a lot of our audience can necessarily get into these opportunities because they require significant amount of funds. So one more time, can you guys tell us who is your ideal person to invest into let me get the name right. Peak Multifamily Trust, right? Peak Multifamily.
Yeah, Peak Multifamily Trust. It's an apartment fund. So I think the ideal person basically is someone that's looking to diversify their portfolio with some real estate. They don't want to be the kind of the hands-on landlord. Don't want to learn it. They have their own lives, they have busy lives, but they want some diversification in their portfolio. Or sometimes people want to get into real estate at some point. This is kind of a way in, kind of a foot in the door. For $10,000, a minimum of $10,000, you can diversify into real estate, and specifically apartment buildings, which is I would argue probably one of the more stable asset classes in real estate.
Yeah. And then how would they learn more? How do they get in touch?
Yeah, they can go to our website, peakmultifamily.ca. There's a bunch of information there. You know, we write, you know, blogs regularly just about the market. You know, there's an investor package if they want more information. Just kind of enter their info, and they'll get sent the investor package right away. And if it's of interest, then, you know, Mike or I or one of our dealer representatives can have a chat and answer questions.
peakmultifamily.ca. Okay, good one.
Yeah.
And of course, that's in the show notes. Everybody, you can get the information there. The links will all be there. Any other ways to get in contact with these guys is going to be in there too. I want to thank you for coming out and sharing all this today. Appreciate you taking the time to come and talk to us.
Yeah, thank you guys.
Thanks for having us.
Great. Thank you guys. Yeah, appreciate it. Actually, I don't know if I mentioned this last time, but like your podcast was the first podcast as I was driving in and out of Toronto, 1.5 hours there, 1.5 hours back. That's kind of steady breakthrough podcast. So, I mean, this was probably 2014, 15. Have you guys been doing the show that long?
Yeah. 14.
Yeah. So, yeah.
Well, thank you. Sandy, how can people get in touch with you?
All over social medias, it's Sandy McKay at it's Sandy McKay or Sandy at McKayRealtyNetwork.com.
Awesome. People can reach me at rob@mrbreakthrough.ca. Thanks again, everybody, for listening, and we will see you next time.